legal and tax matters, both in Silicon Valley and Colombia. So let me start off with presentations. It is my pleasure to introduce the panelists with extensive experience in this matter. We have here today with us Ana Mora Bowen, Colombian Director in Angel Ventures. Ana is responsible for orientating investment opportunities for the Pacific Alliance Fund 2, supporting all due diligence processes to any investment, responsible for AB Network Colombia, including sourcing potential deals for investors, management of all relationships with Colombian allies. Juan Felipe Uribe, co-funder in Alameda. Before co-funding Alameda, Juan spent 5 years in GHE finance sector, working in investment banking at Simons & Company International, based in London, and in a private equity at Ashmore Group, based in Bogota. We also have here today Daniel Green, partner and VC specialist in Gunderson Demmer. Dan works with emerging growth, technology companies, and VC funds, has particular experience with international transactions, and is the co-head of the firm's Latin America practice group. Fluent in Spanish, where he represents international companies, various clients in Colombia, like ADI, Omnibank, Sinove, Grupo Bolívar, Banco Colombia, and Robinhood. He worked with these Colombian companies with our next panelist, Andy Matson, tax partner in Moss Adams. Andy has been providing tax solutions to startups and other technology companies in Silicon Valley since 1985. His specialties include corporate, partnership, individual tax, compensation planning, and international taxation. Andy is head of the Brazil practice of Moss Adams. Our last but very experienced panelist is Fabio Osorio, tax director at J.A. Del Rio in Colombia. With over more than 10 years of experience in international taxation, where he has practiced in different tax update seminars at international levels, he has extensive experience providing tax advisory, consulting, and diagnostic services in due diligence processes and tax planning work. Well, with this being shared with all of you, those are our wonderful panelists. And I would like to say that please, during this transmission, please feel free to send all of your questions, and we'll be happy to interact with you and answer them all. So let's go ahead and get started with the agenda. Alrighty, so here in the agenda, we're gonna talk a little bit about the Colombia Cradle of Startups in LATAM, funders experience, Alameda, venture capital considerations and cross-border investment, tax and legal considerations in the US and Colombia, US holding company, offshore holding company, and Q&A session. And like I said, just send over your questions and we can just start answering them within the webinar transmission. I would like to go ahead and pass over the mic to Ana so she can share with us a little bit more about the Colombian Cradle in Latin America. So please, Ana, go ahead with that.
Thank you so much for that intro, Alejandra. Well, as Alejandra mentioned, I'm the director for Angel Ventures Colombia. We're a venture capital that was founded in 2008, and nowadays we would say that we're one of the most active and influential Mexican VC firms in Latin America. We invest mostly early stage to early growth companies by becoming a leader in Series Seed and Series A, and startups that usually have a very innovative business model tailored for the Latin American market. We manage right now 2 investment funds. One of them is in a divestment period. Our AB Fund 1, or our fund, has already started to return capital to our LPs. and has kept increasing value with solid portfolio. This is a $20 million fund size. It has actually 56 LPs ranging from different family offices, individuals, corporations, and global institutional investors. So we have a wide range of investors. The initial tickets that we invested in this fund were from 100,000 to 500,000, and we were able to make follow-on investments for around $2.1 million. This portfolio was focused in companies that are in tech, retail, health, agro, and fintech. And within our portfolio, we have one of the most valuable startups in Latin America, Clip. It's the largest payment processing company in Mexico. It's ahead of all major banks. And actually, we worked on this deal with our panelist here, Dan Green. So cheers to that. And we've sourced more than 3,000 opportunities for that fund, analyzed 600 companies, and we did that from 10 different countries. Nowadays, our second fund, which is the Pacific Alliance Fund 2, closed as of December 2020. And the thesis basically focuses on some of the main lessons we learned from our first fund. It basically looks at to make our portfolio more liquid for a secondary market and an exit, which we all seek to one day achieve with our portfolio companies. We think this is possible through the growth and expansion of our portfolio companies towards new markets in LATAM. So that's why nowadays we have an office here in Colombia where we find and source deals from Colombia that we think have great potential to one day penetrate new markets such as Mexico, Peru, or Chile, where we find most potential taking out of this Brazil, which is a large enough market by itself. And with this fund that's raised more than $15 million, we've had, between both funds, we had more than 99 limited partners with different nationalities, as we mentioned, and we have more than 36 portfolio companies. One of our portfolio companies is here today. He's Juan Felipe Uribe. He's one of the co-founders of Alameda, and he's going to be telling you a very interesting story that kind of was our first company that did a merger. One of our thesis basically revolves around, we think that there's a lot of copycats in Latin America. So we see the same startup that does basically very similar things in Mexico, Colombia, Chile, or Peru, and we see that they tackle the same problem. So we thought that it could be a way to grow faster if these startups merged and each one implemented best practices from each other, and this way they finish penetrating their own markets, and tomorrow they would own a stake in a larger holding company which was already present in one market. So Juan Felipe will have a lot of stories to tell you about that and the structure that they worked best for them when they merged. And well, nowadays we have a team of 25 investment professionals, and we've invested more than $42 million in different companies. And we see that Colombia is a very interesting market to invest in. We've seen that it's a market that basically is following a bit the steps of Mexico, where we've already had one unicorn, which was Rappi for us, and it's a very a very important company which has given a lot of focus to us. And with this, we've attracted a lot of international investors, and constantly we're seeing these early stage deals which we find have great potential of tackling many of the Latin American countries with many of the Latin American problems we see in our countries. And basically we see that these problems are very replicable towards what we've seen in Asian markets also, which basically the same trends in our Asian markets, we see that replicate in these emerging markets too. So they tackle the same problems, and we generally see that these startups that tackle these same problems are sometimes a copy of what we've seen in Asian markets. So we like to look a lot what is also happening in other emerging markets. And I think the biggest opportunity is basically in the middle class. We have this very very large middle class, which keeps growing. And we think that there is great opportunity to find for the startups to tackle this and keep penetrating and tackling new problems. So with this.
Well, thank you so much, Anna, for that huge overview. I mean, that's wonderful experience with Angel Ventures. Thank you so much for that.
Thank you.
Now, like you said, let's go ahead and talk with Juan Felipe and get to know his founder experience. Alrighty, so Juan Felipe, can you tell us a little bit about how Alameda project came out, and what do you do, and in what countries is Alameda located in?
Sure. So everyone can hear me well. Alameda is currently, we operate as a marketplace in the furniture sector. And basically what we do is that we put together supply and offer. We try to bridge what the customers are looking for and a large supplier and producer based in both Mexico and Colombia in terms of everything home decor, home furnishings, furniture, and all that's related to this vertical. So it's quite a funny story, as Nasana was mentioning. Alameda came together as a merger of two companies that basically were doing the same stuff in both countries, right? So I started with another business partner in Colombia in 2016 with what used to be called Mubler back in the days. And our Mexican business partner started Alameda in 2015 in Mexico. We were doing a fundraising process. We were trying to contact investors back in 2018. And we came to meet Angel Ventures through an introduction from one of our friends. And then we started to meet Anna, we started to meet Hernan and Camilo, which are the other partners, and they basically introduced us to our Mexican counterparts. And it was a pretty interesting story because there was an argument to be made about effectively putting together companies that were doing the same thing, that are tackling the same problems in different countries, probably different approaches, but certainly many, a lot of knowledge to be shared and many experiences to basically to argue and to make sure that you don't make the same mistakes twice in two different countries. So we met with the guys from Angel Ventures. We traveled to Mexico. We met the guys in Mexico. We saw that we had the same ideals. We were chasing the same dream and the same mission, if you want. And there was a cultural fit amongst us as well. We were trying to to achieve the same things through the same means. So we decided to merge at the end of 2018, and holding the hand of basically of Angel Ventures as our investor back in that deal. So that's how the company came together. We're currently a team of 60 people in both Mexico and Colombia. And we have one of the largest catalogs in Latam, where, as Anna also mentioned, we're trying to take our solutions to other countries in Latam that have the same problem. So we're looking at Peru, looking at Chile, see what's happening there, and probably trying to move there within a couple of years from now.
Yeah, well, you'll see that Alameda will go to many places. I'm so happy to hear that. So when you said that you were raising capital and you got to know the Angel Ventures, how was that process? Was it complicated?
Yeah, I mean, probably very, very pinpoint to the topic of the discussion itself. Trying to dispel these myths around raising capital. The fundraising process is quite arduous, I would say. I mean, it takes a lot of time, and takes a lot of effort, a lot of patience, but it's definitely worthwhile, and it's something you can't quit. We talked with many investors back in that time. I can't remember how many people we actually contacted. We managed to get the introduction to Angel Ventures through another entrepreneur friend that had already went through different fundraising rounds in his company. That's a great way of getting to know other potential investors that people know that are active in the region, right? So you definitely have to try to leverage your network. Try to make sure that you come to webinars like this, or talk to some other entrepreneurs in your country, and see how you can get to contact different people. So I wouldn't say it was hard itself. It's just a process that takes time and effort, and you have to be ready. I mean, there's a lot of materials out there online that you can read, and you can make sure that you're prepared before you actually start fundraising. And I think another great piece of advice as well is that make sure you fundraise with enough time before you actually run out of money. That's something that, you know, it's easier said than done, but you gotta make sure that you have a runway of at least 6 to 12 months because it always takes time. You have to first talk to people, talk to investors, get them to get excited about your company, and that can take probably 2 or 3 months. Then if you actually get to the second stage with one of those investors, due diligence processes can take also a couple of months depending on who you're talking with. So you gotta make sure that you have the time and you have the focus as well to you know to keep on leading this process, and also don't overlook your business. I mean, sometimes founders struggle between, okay, either I focus my time on fundraising or I focus my time in running my business. You gotta make sure
Yeah.
that you can do both, because it's important to have a
You have
grip
to
on
multitask.
thing. Exactly.
Excellent. Thank you, Juan. So maybe I just want to know a little bit more about like the merging part. Like how was that merge about? A little bit more detail in how or what benefits did you get out of merging?
Right. So that was quite a funny story, and it turned out to be a little bit more complicated than we thought, because this merger was between, you know, shareholders that were based in different jurisdictions. So we had the Colombian company with Colombian shareholders. We had the Mexican company that had a cap table that was a bit more mixed. There was the founders, there was friends and family, which were also Mexican tax residents, and then you had the BC funds, which sometimes are in Mexico, sometimes are in the States or in Canada or somewhere else. So we have to come up with a solution for what's going to be the best jurisdiction for this company to merge and to operate. Where are we going to set up the holding company, right? So we consider many different things. I guess, you know, the best piece of advice that I could give people on that matter is to, you know, get a good lawyer, get a good advisor, to put your own personal situation into consideration. We basically look at different things like, are we going to distribute any dividends in the future or not? What are we tax based? What are you tax resident? Is it the States? Is it Mexico? Is it Colombia or somewhere else? Um, what are the future rounds you're going to raise look like? Are you going to go to institutional investors, probably in the States, in Europe, which probably would more likely consider United States as a base for investing? Or depending on the jurisdiction you're going to work, is that jurisdiction considered a tax haven, or probably something that a multinational company or an institutional company is not willing to invest? Are there any double taxation agreements? What is your tax situation as well? So we decided to set up our holding in Delaware, in the United States. That served well our purposes, because we had, as I mentioned, we have two BC funds in our cap table. One of them is based in Canada, one of them is based in Mexico. We have many different people from different backgrounds, and for our projections and for Alameda's case and what we were looking to do in the next following years, that was the jurisdiction that made sense. It took us a while to close the transaction, basically to do a flip. So you had to get your shareholders in each of the operating companies become a shareholder in the holding company, right? So you have to make that change, and that took us a little bit. I wouldn't say it's complicated. It's just something that, you know, you have to make sure you make it right, that it doesn't have a large tax consequence on yourself and on your investors, and you know, all the paperwork to set up a new company. Well, it just takes time, but it's something that you can do. There's many smart people out there. There's many smart people here on the call with us that I'm sure can advise you guys on that. So that's our story. That's how it turned out. And just to finish, being in Delaware made it a lot simpler to raise rounds in the future, because many investors already know the jurisdiction. They know how it works. It's pretty standard, and it makes it a lot easier if you're going to raise funds from outside investors, from international investors. They get comfortable, and I guess Delaware is in a good jurisdiction for them to invest in.
Excellent, Juan. Well, I mean, thank you so much for sharing this wonderful experience. It's very interesting. I hope the audience can relate to this. And at the end of the day, we have our great specialists, so we can go into detail about these structures and the importance of just what Juan Felipe said. So I would like to move on with Dan, Andy, and Fabio so we can talk about the venture capital considerations and cross-border investment, tax and legal considerations in US and Colombia. And well, they'll be talking about the main international tax structures and provide a better understanding so you can ask us any questions and we can just stop and talk a little bit about what's going on with your company. So I'll go ahead and pass over the mic to Dan, and you'll all be very interested in this part.
Thanks, Alejandra, and thank you, Juan Felipe. Great to hear your insights from your experiences that you lived. And I think the questions that Juan Felipe sort of posed as it relates to how you think about a holding company and how you think about your financing path are really important. So the questions being, where do you expect to raise capital from in the future? Where do you expect to have your operations, your employees, your customers, your suppliers? And if you have a crystal ball, where do you expect the exit of your company to be in the future? Is that going to be a sale to an international buyer in the US or Europe? Or is it going to be a sale to a Colombian buyer or an IPO or something else? And what Andy and I and Fabio spend a lot of time helping our clients is trying to provide guidance based on those questions, because those questions largely define how you should set up your company, how you should go forward with your tax and legal and other structuring. We can go to the next slide now, but basically, if there's one thing that I would like this audience to take away today, it is don't blindly follow your friend from business school, your tío, or any of us by saying, I need a Delaware corporation or I need X for my company. It is a nuanced analysis and it is specific to your situation. Andy and I spend much of our time basically working with a couple of different legal structures. Delaware is by far the most common for US oriented businesses. And as Juan Felipe mentioned, it has significant advantages in certain types of contexts, but it's not for everyone. And we have many clients that have operations exclusively in Colombia or Mexico or elsewhere in Latin America, where they would not be best served by a Delaware corporation. Why? Because we're going to come on to that later in the presentation, but it is very tax inefficient. There are alternatives to Delaware, specifically Cayman or the UK, which we'll address, that are more tax efficient in many situations. Bottom line, from a legal perspective, you want to make sure you're protecting your assets. You're protecting your intellectual property, your physical assets, the team, that you have a holding company structure that provides that protection, and that everyone, whether it's the investors, founders, team, advisors, they all own a piece of the top company. And you don't want to have a situation where you have some investors owning a part of the SAS in Colombia, which is a subsidiary of a Cayman or Delaware company, where other investors hold their stakes, and you have multiple levels of investors. That is a recipe for complexity and a potential roadblock to financing and growth of your company. So you want to have everyone at the same level. You want to protect your assets. You want to make sure your intellectual property is clearly owned through intellectual property agreements, cesiones de derechos de propiedad intelectual, if you will, and that everyone that works for your company and is signing those agreements. From a US investor perspective, they take a very broad brush approach on intellectual property. And you might be thinking, hey, that's just marcas, that's just registered trademarks, or anything that I register, that's intellectual property. The investor in the US or elsewhere thinks of it more broadly. It's anything that's in your head as a founder or your team's head related to know-how, related to business plans and customer lists and strategy. All of that is know-how. From the most junior employee on your team to the CTO and CEO, they're all creating intellectual property, and that should all be captured by your company, and make sure that that is protected accordingly. As Juan Felipe mentioned, there are many situations where we're going through flips and we're creating holding company structures where you're trying to solve for the preferences and the needs of many different parties in many different countries. And that's why what Juan Felipe described is so complex, because it's not always the case that the choice that you think as founders is best for your investors, or might be best for 12 of your 15 investors. The reality is, in those situations, you try to solve for the structure that meets the greatest number of needs. Generally speaking, it's your lead investor or lead investors and your founder team. But it's always a little bit of a balancing act. In the same way, when you're going through the financing process, you also want to plan for the future. You want to plan for the future from a tax efficiency standpoint, and you want to plan for the future from an investment standpoint. What do I mean by that? I mean agreeing to an investor rights agreement and a shareholders agreement and a term sheet in your financing that sets the ground rules and facilitates future financings. So what we see a lot of times in our clients in Colombia and elsewhere in Latin America, when they're raising money in the early stages of their startup journey, it's tempting to take whatever money you can. Money is hard, it's scarce. It's not easy to fundraise, it's distracting, it takes time. So there's a tendency to do safe financings with low caps or a side letter and agree to whatever terms an investor may propose to you. And you really want to be thoughtful about that and make sure you have good legal and tax guidance, because anything that you agree to in the early phase of your startup is going to be something that you will likely live with in your later financing rounds. Give you a clear example of that. In a preferred financing round, Series A round or Series Seed round, you have a liquidation preference that's given to the investors. That's a core feature of preferred shares and what investors will expect. That liquidation preference is a protection on the downside if things don't go quite as well for the investors. It's not something that's given to the founders who hold ordinary or common shares. That liquidation preference, generally speaking, is defined in the vast majority of deals internationally and deals that we see as a 1x non-participating liquidation preference, meaning the investor gets their money back, 1x, or they have to convert their shares to ordinary shares if it's a big exit that everyone shares in the proceeds based on their ownership of the company. And they don't get more than that. However, some investors that might feel they have leverage will push for something more aggressive and more investor friendly, such as a 2x liquidation preference, where they get 2 times their money back before they might need to convert. Or they get a fully participating liquidation preference, which is basically a way of basically taking their money on the downside and getting additional money when they have to convert. Those are off market, those are investor friendly in, I would say, 20% or less as we see them. So if you agree to that term now in your Series A or your Series Seed round, the next round of investors going to see that, and they're going to likely ask for the same treatment. And then even if you may have a lot of leverage at that point and the company is doing fabulously well, it's going to be a hard negotiation to claw back or take away from your earlier investor something that they already won. So be mindful of that. Last point I'll say on this topic is, in addition to the tax and legal structuring, all of which are very important, be really, really cautious about dilution, meaning giving up ownership of your company. That's not a bad thing by its definition. Fundraising means you're giving up a share of your company, and that happens all the time. It's a natural process as part of a startup's journey. But what can hurt a company in a significant way is over dilution. What I mean by that is basically dilution of the founding team and the management team and the key employees that goes beyond a certain typical norm or a typical range. generally speaking, and this is just a rule of thumb, 20 to 25% of your company should be given up at each major fundraising round, Series Seed, Series A, etc. And we have situations, Andy and I, where companies maybe have been around for 3 or 4 years. They've taken a while to get product market fit. They maybe have pivoted, changed business lines, changed management teams, etc. They finally get into this right opportunity in the business, and they're getting a lot of product market fit and traction, and they're raising that long-awaited Series A round. But because they've been in that journey for quite some time, or they've raised lots of safe money at low caps, the time that they're raising the Series A, the founding team might be owning only 55 or 45% of the company, whereas the typical company at that stage, the founding team might own 75 or 80% of the company. That type of cap table and shareholder arrangement makes that company almost uninvestable. Even though their business might be really interesting and the team is great, most investors, because they have a lot of opportunities to invest, will look at that cap table and say, I just don't want to do the work to have to clean that up. I don't want to be the bad guy to do that. And even though you have a great business, the cap table makes that company uninvestable. So be cautious, be thoughtful, and understand the dilution of each fundraising stage. So I think we can move on to the next slide unless there are any questions. Yeah, so this is basically a framework for thinking through some of the issues that we're going to talk about in more detail in this presentation. It is a mix of tax and corporate and investor considerations when you're thinking about a holding company. So tax is really important. You can't get lost in what's the overall objective. And so Juan Felipe mentioned dividends, right? Dividends are, in my world of advising startups that are high growth, technology driven companies, they almost never declare dividends. Why? Because those types of companies, and you guys maybe this type, are investing in growth. They're reinvesting any profits or revenues into growth. They're not distributing dividends to shareholders. That type of dividend model is more likely to be a mature company that's been around a long time, that's slower growth, that's not investing in that hyper growth. And so dividends really aren't very relevant in how we think about our types of clients. And if you get tax advice from an advisor where they're really focused and fixated on dividends because they think that that's what is important, you need to take a step back and say, guys, let's not lose sight of the fact that dividends aren't relevant to this analysis. But on the other hand, if you are a type of business where you maybe aren't going to raise venture capital in the near term and you are going to be distributing dividends, then withholding taxes, which are mentioned in the first bullet point and sub-bullet point, are important because withholding taxes apply when you're moving money across borders. And that might be the case where your shareholders are in Canada and Mexico and you're based in Colombia. So withholding tax would be important in that situation. But you really want to think through what's the relevant strategy for your type of company. Andy, I don't know if you want to cover any of these bullets in a little bit more detail.
And I think that the last one, I guess, basically, if you're going to raise money from U.S. investors, there comes with that a little bit of baggage. And there are these passive foreign investment company rules, or PFIC rules, which date back to the Reagan administration, 1986, and these controlled foreign corporation rules, which actually date back all the way to the Kennedy administration, 1962, the year before I was born. Unfortunately, neither of these rules, which have an effect on your U.S. investors, neither of these rules have really changed much since those times, since they were enacted. And obviously, the world has changed since then. You know, venture capital was never used really in the 60s and only, lightly used in the 80s. So these are issues that you probably will come across as you fundraise. And, it's important that you essentially not ignore them and make sure that you're properly advised so that you don't cause some major problem down the road when you're trying to raise a subsequent round from an investor. As you raise more money, as you'll find, the larger the investor, the more sophisticated they are, and the more attuned they are to these issues. So again, they're not things to be poo-pooed.
Yeah, that's right. So why don't we move on to the next slide? Now we're going to really work through some kind of real world examples of holding companies based in Delaware or other places, and how that affects taxes and the economic returns on different types of exits. As Juan Felipe mentioned, he has a Delaware corporation. That's going to be the focal point of Alternative A. And a side note on Delaware, Delaware is one of 50 states in the US. It's a small state. It's not very relevant, to be honest, in much of the economic activity of the US, other than it's a really important state for setting up US corporations. The reason being is because it has specialized in being predictable and having good governance and good corporate laws that provide a lot of assurance to shareholders and boards as to what their liabilities are. And the tax rates are very low in Delaware, and you can turn around things very quickly. It's got a lot of advantages, specifically for US businesses or businesses that are focused on US-centric business models. And so if you do end up setting up a US corporation, we would recommend Delaware as opposed to Florida, Texas, New York, or another state. But we want to leave you with the idea that you don't blindly follow Delaware if you're going to go down this path. So why don't we move to the next slide? So I'll start, and then Andy and Fabio, you guys can jump in as well. As we talked about, the Delaware Corporation has quite a few benefits. It is quick and easy to set up. It is familiar to many investors. Almost all investors in the US would be familiar with the Delaware Corporation. Many investors in other markets, including Colombia, would likely be familiar with the Delaware Corporation. You do not have to publicly file your shareholder list. So the ownership of a Delaware corporation is not something that's publicly available. So you have that as an advantage. And you have the ability to grant options to US taxpayers who are employees. So if you're going to have a US based team, maybe some employees in the US, you can grant what's called an ISO option, which is a tax incentivized option, which lowers the tax rate if certain conditions are met for that US taxpayer who receives the option, which is great. It's not available to Cayman entities, which we'll talk about. If you're not going to have a US team member, it's not really relevant, so you don't have that advantage. But there's also another tax advantage, which is called qualified small business stock, or QSBS, which is mentioned on that third bullet point, which is available to Delaware corporations and not available to Cayman or other companies. So there are some significant tax benefits to a Delaware corporation, and it's not always bad, which we'll discuss. It's got a lot of advantages, but it does have the drawbacks that Andy's going to mention now.
Yeah, so we'll show this in the next set of slides, but in general, and I've been in Silicon Valley. If we go back to the other slide first, I apologize. I've been in Silicon Valley since 1985, and every US-based tech startup is going to be a Delaware. It started out at least as a Delaware C Corp. Google, Facebook. I mean, you look at Stripe, which has got a $95 billion valuation. I used to do their work. Delaware C Corp. Okay, but they are active U.S. businesses with headquarters, R&D, all this stuff, and employees in the U.S. So it's important that you understand the difference between an inactive holding company that may be set up simply to raise capital from outside investors, issue them stock, and then hold the investment in, say, your Colombian operating company versus a company that has major operations in the U.S. I have a colleague who refers to a Delaware C Corp as a Roach Motel or a Hotel de Cucaracha. The problem is once you get into a Delaware C Corp, it's very difficult to get out. Dan and I have worked on some of these where the founders were not properly advised and they set up a Delaware C Corp simply to raise a fairly small round of safes. And this becomes, a major $100,000 exercise to get out of it in the future when you want to raise a Series A from a sophisticated investor that knows that this is a bad structure. And it has tax consequences that you can't get out of. So it's something to very carefully consider, particularly if you're not going to have operations in the U.S. So that's that. So why don't we go to the next slide? Again,
Andy,
go ahead. Yeah.
I'm sorry, Andy. Just talking about maybe in the next slides and further we're going to explain. But also one of the drawbacks that it is also important to consider when we are talking about Colombian founders is the anti-abuse rules that Colombia has set in the last tax reforms, which one of them is the indirect sales. We are going to explain that later, but it's one of the of course, the drawbacks that it is needed to be considered, because if it is not easy to go to exit from the US, and having the indirect sales and the direct rules will make it more and more complicated.
So there are two types of exits that you can have. If you have a holding company structure, you, the founders, and the investors can sell your shares in the holding company to the buyers. And in that case, whether you have a Delaware holding company or an offshore holding company, we call offshore, it's really the same tax answer, at least for US purposes. Colombia may be different. What we try to plan for, though, when Dan and I are advising our clients that are going to have US investors, okay, you need to be able to be flexible enough to have a good exit that's not going to kill you on taxes if the buyer wants to come in and buy just the operating company from the holding company. And we think that particularly in the fintech space, given regulations and all that exits where the holding company is selling the operating company is probably more likely, and we're seeing some evidence of that. So in the second case, where the holding company is going to sell the operating company, let's take a look at what happens when you have a C corporation as your holding company, which this slide shows. And we'll just assume, and both of these examples we're going to show are going to assume a $20 million exit where the holding company sells the operating company to a buyer. Now let's go to the next slide, please. So what we talked about is the Delaware holding company is a taxable entity. And what that effectively means is that you're going to have two levels of tax on the exit where the holding company is selling the operating company. The first level of tax is at the holding company level. And if you have a Delaware C Corp, that has to pay tax because it's a taxable entity at 21%. So first, the US C Corp gets the $20 million. And in this case, it has to pay 21% tax, or $4.2 million of tax, leaving after-tax proceeds of $15.8 million available. Now, the US C Corp those funds are no use to anybody in the C Corp, so they get distributed out. In this case, half to the founders, half to the fund investor. 15.8 million divided by 2, that gives you 7.9 million to distribute to the founders and the VC funds. But they then have to pay tax on that dividend. So that's a second level of tax, and we're using an example tax of 2.6 million here. So the founders and the VC fund investors in total end up with $10.6 million, which works out to a tax rate of 47% overall. And I think that most of you would probably agree that a 47% tax rate is not what you want to do when you have an exit. So again, this is what happens when you have a C Corp in the structure as the holding company. And again, the exit comes in the form of the holding company selling the operating company. If we go to the next slide, please.
Just let me add
Yeah,
something,
sure.
Angie, just talking about Colombia, and it is a really huge percentage that you have to pay in those steps as you talk, Angie. But nonetheless, in Colombia, the founders, as the founders are tax residents in Colombia, they have to pay taxes based on the worldwide income. So those dividends won't stop taxed not just in the US, but also in Colombia. So the founders, as soon as they receive the dividends, they have to include it in the income tax return in Colombia. Despite of that, it is possible to use as a tax credit the taxes paid abroad, but it is limited to the tax that the founders or the tax residents has to be paid in Colombia. So that's one of the other things that it is important to consider when is happening in this scenario, because it's not just the tax that it has to be paid in the US, which is very high, but also what is happening for the tax residents in Colombia.
That's a good point. So what Fabio is talking about is using the credit mechanism that Fabio is talking about. That would avoid a situation where you had 3 levels of tax. And it's in this situation, essentially, on the dividend portion, the $7.9 million coming out to a Colombian founder, the tax rate on that essentially would be the lesser of the US rate of 30% or the Colombian tax rate. Pardon me, the higher the rate. So you're going to end up paying the higher of the 2 rates. Anyway, let me go to the next slide. So this shows us we don't get a great tax answer when we have a C Corp in the structure and it sells the operating company. Now, here's the alternative B, the quote unquote offshore holding company, which, and let's go to the next slide, please. So the advantage of having again, this assumes that you're not going to have major operations in the U.S. You're not going to have a headquarters in the U.S., not an extensive amount of business. Although I will say, if you want to enter the U.S. subsequently, this holding company structure will allow you to do that. You just don't have to have a headquarters in the U.S. to do business in the U.S. So from a tax perspective, Cayman and the UK are essentially identical. The UK is a taxable jurisdiction. Cayman doesn't have any income taxes. However, the UK has something called a substantial shareholder exemption, which allows for a UK holding company to sell its shares in a subsidiary, and there's no UK tax on that. And then when the dividend is distributed, the UK also doesn't impose a withholding tax. So strictly from a tax standpoint, the UK and Cayman are basically identical. Now there's one small difference, and that is when the holding company is sold by the shareholders. If you have the first kind of exit, there's something called a stamp tax that applies in the UK, which Cayman doesn't have. And I want to say it's 0.25% or something, but that could be material in a big deal. One thing that you may think, well, gee, I want to raise money from U.S. investors. I mean, they're not going to like the UK, and they're certainly not going to like Cayman, right? Well, the kind of investors that you're going to want to see on your Series A, the big ones, so the Accels, the Kazakhs, Monashis, the ones that are active in Latin America, they love Cayman and they're fine with the UK. And the reason for that is they're aware, they are up on this double tax thing that the C Corp problem creates. In fact, we find many situations where companies form these C Corps, and as I was talking about earlier, they have to unwind this in order to raise the Series A because these sophisticated investors don't want to invest in a C Corp. Every situation's different, but I think that it's a mistake to assume that the kind of investors you want to put on your cap table are going to shy away from a Cayman or UK holding company. The Cayman has the advantages, the same advantages of a Cayman and the UK both can issue stock options. They can both issue preferred shares. And Dan, correct me if I'm wrong, but they both have really good, I think, IP protection.
They do, yeah. In the margin, when we're comparing Cayman and UK, I think from a corporate perspective, Cayman is slightly better if it's workable for your investors because as the drawbacks that are mentioning, it's a little bit more expensive, but even more important than that, you do have to file your financial statements and your shareholder list in the UK so that they are publicly available to anyone who might be able to look online and find that information, as opposed to Cayman and also Delaware, where that information, the financial statements and your shareholder list, are not publicly available. So for companies that are in stealth mode or that are in very competitive industries where they don't want their competitors to know how financially stable they are, who invested, who's on their cap table, their shareholder list, that is something that can be sensitive, but it may be outweighed by all the tax benefits that Andy is mentioning. And it is the price you pay in the UK for not being a paraíso fiscal, for not being a tax haven, because you have to give up that information as opposed to Cayman, where that information is private, but you are in a tax haven jurisdiction.
Dan mentioned QSBS, or Qualified Small Business Stock. That's something that's available with the Delaware C Corp that's not available with a holding company outside the United States. But this QSBS thing is only available to US investors. And I think that the math clearly shows that the avoiding a double tax on exit is much better for everybody. And certainly, again, if you're going to have the inactive holding company, a founder who is not a U.S. resident, not a U.S. citizen, doesn't benefit from the QSBS treatment at all. So anyway,
in this case,
and you may encounter investors that are really excited about that because it is a big benefit. It's essentially a $10 million tax exemption on capital gains, but it gets you nothing. Let's go to the next slide, please.
If I mind just explaining a little bit what Dan mentioned, Dulce, if you can go back. Yeah, thank you. One of the things that from the tax perspective in Colombia that is important to mention is the Cayman was considered as a tax haven, as Dan mentioned. Nowadays, it is not, but it can be in the future. Instead, in the UK, Colombia has a tax treaty that can be used in these operations, in these transactions, and it can be helpful from the Colombian tax perspective because it will be a specific percentage used for this double taxation agreement. So it will be important as well to consider that. Even for the investors, might be important to be Cayman, but if you have a UK entity, maybe it will be efficient from the tax perspective in Colombia. Yeah, if we can move.
Okay, so
yeah.
So we go to the next slide, please. So if you recall a few slides ago, the holding company that the investors, that the VC fund and the founders invested in was a Delaware C Corp. Here we've substituted a Cayman or a UK holding company. And again, we've kind of listed out the benefits and the drawbacks. We've added in a Delaware limited liability company in between the holding company and, say, the Colombian operating company. The Delaware LLC is essentially a nothing entity for tax purposes. It can have some legal benefits. It's especially important from a tax perspective if you're going to be going into, if you're going to be expanding into Mexico or Brazil. I think that it's not necessarily a must in Colombia, but essentially don't worry about the Delaware LLC. It's kind of a nothing entity, but you'll see it in most structures that invest in Latin America. So again, here we assume the same facts where we have a $20 million exit where the holding company, in this case the LLC, is selling its shares in the Colombian operating company to an outside acquirer. If we go to the next slide, please. So the main difference here is that when the Delaware LLC, which is the Delaware LLC and the Cayman or the UK company are essentially one and the same. When that holding company sells the operating company, it doesn't pay any tax because it's not a taxable entity. So therefore, you only have one level of tax. And generally what we would do for the Cayman or the UK company is we would make an election to treat it as a fiscally transparent entity for US investors, which doesn't matter for you founders. But essentially, you notice the difference. One level of tax versus two. In the first example, where the Delaware C Corp was the seller, the after-tax proceeds were $10.6 million. Here, there's only one level of tax, and the after-tax proceeds are $13.44 million, significantly higher. So this math, I mean, every shareholder and every founder situation is different. You know, you have to kind of go into a model like this with a certain amount of constants in the formula. But you can't get away from the fact that having only one level of tax versus two dramatically changes the tax answer on exit. And this kind of a dynamic, again, is why you will find that the investors you want on your cap table at Series A or even earlier, they are aware of this dynamic, and not only will they embrace it, but they may you may get shunned if you have, again, depending on your facts and circumstances, on your particulars, you may get some pushback if you have a Delaware C Corp. So it's just important to think about these things early on.
Yeah,
and let's go to the next. Go ahead. I'm sorry.
Very
Probably,
important. Yeah, in the next slide, I just want to explain a little bit deeply what is the indirect tax and how might apply in Colombia, because it's very important in this scenario that is just one level of tax, as you mentioned, Andy, but it's also to consider for the shareholders or the taxpayers in Colombia, that that is a specific rule in Colombia, which is called indirect tax, was set in the last tax reform, as I mentioned, in 2019. And it considered the indirect sales of shares, interest, or assets located in Colombia through the disposal of shares, interest, or rights of foreign entities, which is this scenario in the scenario where you're selling the LLC. In this case, so you will trigger this indirect rule in Colombia, and depending on the time that you have held or the individual shareholders has held the shares will be taxed. If it is less than 2 years, the taxation in Colombia will be 31%, the tax rate. Instead, if it's more than 2 years, the tax rate will be 10% as a capital gain. So it is very important, that scenario, because normally when you do this kind of transaction, it will take more than 2 years. But if you do before that 2 years, it is important to consider that in Colombia you will be taxed on 31%. Nonetheless, if you use the UK, as I mentioned, UK and Colombia has a tax treaty that you can use, and in this case, the sales will be taxed just with 10%. So it will be equally in the scenario even if you don't hold the shares for at least 2 years. So that is very important for the Colombian tax perspective.
I would like to say that we do have a couple of questions from the audience. Would you like for us to wait for the Q&A, or, well, we were on the last slide. So let me just start off with a couple of quick questions regarding these last slides. It was, what are the key legal differences between having a UK and a Cayman holding company?
Yeah, thanks, Alejandra. So key legal differences are not all that great. You can do things from a financing perspective with both a UK and Cayman company, such as you can create a stock option plan, an ESOP plan. You can do preferred share financings. You can do safes. But there are some subtle but important differences. So for example, share repurchases, share buybacks, where the company is buying back shares from its existing shareholders. Those have become more common in the last few years as a way of doing a secondary transaction to return capital and provide liquidity to early investors or some founders. Sometimes that happens in conjunction with a new funding round, a new primary issuance, where the company is raising capital, maybe in a large Series B financing, and is also going to do a secondary transaction by buying back shares. In the UK, it is more cumbersome, more difficult to do a share buyback than it is in Cayman, because their rules are a little bit more strict as to capital requirements and the process that you have to go through. It's not impossible, it's just more difficult. So there are things like that that make the UK a little bit less agile than Cayman to do typical things that a startup does, but that comes with the benefits of some of the tax attributes that Andy and Fabio mentioned. So on the margin, if you're saying, well, my investors aren't comfortable with Cayman, they are comfortable with the UK, and it's not going to be a tax haven, then that would probably tip you in favor of the UK.
Excellent. Thank you so much, Dan, for that. I did have other couple of questions during your presentations of Fabio, Dan, and Andy, but let's go ahead and just start off with the Q&A session. And I would like to say that thank you so much for all of your other slides talking about the structures. It was very interesting. So let's just move on with the other question that I have here. It's actually almost the same question, the one I asked right now, but it would be on the tax differences. Fabio, can you help us with that?
Yeah, sure, Ali. As I mentioned, maybe the main one is that UK has a tax treaty with Colombia, instead Cayman now. And even if Cayman today is not considered as a tax haven, it was considered like 10 years ago for Colombian. So it would be possible that in the future, Colombia consider as well the Cayman as a tax haven, and the investor won't feel comfortable in that scenario. So I believe that is the main difference. And of course, having a double taxation agreement or not will be impact directly on the tax rate that it has to be applied.
Excellent. Thank you so much for that clarity, Fabio, because I know in this matter it's very delicate. So also, if your questions are a little bit more personal, please use the emails that you see in the screen, and you can just send them a little bit more personalized, and we'll be happy to answer them in a later call and get to know you a lot better. I have here another question, and it was a little bit about the flip. Let me pull it up. When is the best time to do a flip, and how much should I budget?
Yeah, that's a great question, Ali, and one that is a little bit personalized, but in my view, my opinion, the best time to do the flip is where you are raising international money from a VC investor, an institution, that is significant enough to justify the costs and the distraction and the time to do the flip. You've got to plan for a several month process to do the flip. Usually 2 to 3 months at the quickest. We've done flips, Andy and I, where it's taken 6 months or longer. Hopefully not that long in your case, but certainly 2 to 3 months. And it's expensive because you have US advisors or international advisors, and you have your local Colombian advisors, both tax and legal. And so easily the transaction costs, when you add all of that up for a flip, can be $50,000 or $100,000 or somewhere in that range. It's probably not going to be $5,000. It's going to be significantly more than that. And so you have to budget accordingly. I use a rule of thumb that if a company is raising a couple million dollars, 2 to 3 million at the minimum, then it probably makes sense to do the flip because the costs would be justified by that financing round. If on the other hand, you're raising $500,000 or less, maybe not worth it until you wait until the next round where you're raising a larger amount. It is fundamentally a decision that involves a variety of different parties. It involves you and the founding team, involves your investors that you might have in the company at that point in time, and it also involves the new investor or the new lead investor who is deciding to invest in your company, sometimes based on the flip. And so what we have, Andy and I have these conversations a lot where we have clients that are at a very early stage. They're planning for success, planning for a good fundraising in the future, but they don't know from whom. And they're still early enough where they haven't gotten a term sheet and they don't know that they're going to be raising a couple $1 million. And so sometimes the best answer in that case is either keep your existing structure, keep your SAS in Colombia, and wait until you're ready for that term sheet, and then you move forward with the flip. If there are other deciding factors that require an international company for you, but you're not yet ready to set up the full-blown structure, or you don't have the term sheet for the several $1 million financing round, you can set up a Delaware LLC. Andy mentioned that in the context of the intermediate holding company, but sometimes the LLC can be used as the ultimate holding company simply to provide some interim benefits. So it's not going to be the structure that you will ultimately use likely in your financing with the international investors like CASEC or Monashis, but it may provide you with a flexible, agile international structure for the time being that you can then easily flip to Cayman or the UK or a Delaware corporation when you are raising the next round in the future. I wouldn't recommend that for every case, but it's a possible option. Andy,
definitely, I agree completely. I mean, it's certainly not out of the ordinary, and we see a lot of situations where a company will raise a round with safes, and will do that by setting up the LLC, which is a fiscally transparent entity. In case there's an exit, you would not pay the double tax. And then, it's kind of a bridge structure to when you do the Series A or maybe a larger seed round. But at that time, then you would essentially, the founders would contribute your shares of the LLC, your units of the LLC into a Cayman or a UK holding company. And then you've got a little more money to pay for the infrastructure. But the LLC is generally doesn't survive when you go to a Series A, because a lot of these venture capital funds, the ones that you want to raise money from, they want preferred shares rather than units in an LLC. I mean, there's always exceptions, but in general, you're going to need to go to probably the Cayman or the UK. Or the C Corp, depending on what your ultimate goals are. But the LLC is a good bridge for instance, raising a note round or a safe round.
Excellent. Those are wonderful answers. Hopefully that answered the doubt from the audience. So let's go ahead and look at a couple of more. I do have plenty of questions, but we are running out of time. So let me just try to provide. Angel Ventures only helps in Mexico and Colombia if a startup is from another country.
No,
What other-
Angel Ventures the fund invests in Mexico, Colombia, Chile, and Peru. That's our core countries, but we can look at deals coming in from other countries that potentially want to penetrate one of the Pacific Alliance countries. So for example, we have an institutional investor from Korea, which enables us to look at Korean companies that want to go into the Pacific Alliance.
Okay. Excellent. So yeah, please feel free to send these personal matters to Anna. She'll be happy to help you direct this assistance. Let's see. I have another one. How should I plan for regional expansion within Latin America? I have a holding company.
Yeah, so generally speaking, once you have your holding company, whether it's in Cayman, UK, Delaware, you're going to have your local subsidiaries underneath that. So think of it as basically each country where you're going to be operating, at least at a significant level, should have its own subsidiary. Why? Because you want to protect the overall structure and all of your assets from liabilities in that particular country. So if there are labor liabilities, if there are tax liabilities, if there are intellectual property issues of that country, it's limited to that subsidiary. And you're not exposing your whole ultimate holding company or its other entities to those liabilities. So we have companies, Corner Shop's a great example of one of our clients that Andy and I have worked on, where they have operations throughout many places in Latin America, and they have many subsidiaries that all hang from their LLC, which hangs from the Cayman holding company that they have. So you may end up, if you have regional expansion, Mercado Libre would be another great example. I mean, they probably have 30 or 40 different subsidiaries in many countries, and sometimes multiple subsidiaries in the same country for different reasons. We would caution you, I mean, it gets expensive and complex to manage that over time. And that's why regional expansion is something to be embarked upon, usually in the later stages of your company. But I know there's clients that we have that are pushing that boundary and moving quicker to expand in the early stages of their company. So you kind of have to navigate that issue.
Super, super. Well, that sounds.
And if I could just add real quick, one of the things that we see, Dan and I get involved, and Fabio as well, on due diligence when companies are doing, rounds of financing. And, again, the larger the investor, the more sophisticated they are, they'll have the better lawyers they have. And invariably, there are questions on taxes. And, okay, where do you have employees? And if you have employees in a country, let's say your Colombian company has employees in Argentina, but there's no legal entity set up in Argentina. Well, that probably has created some sort of an income tax or employment tax or some other tax problem in Argentina. And, these lawyers for the investors, they jump on this stuff. That's what they're paid to do, and they make a big deal out of it. So essentially, ideally, when you have operations in more than one country, you do want to, as Dan said, you want to have a separate legal entity, because not only from a tax perspective, but others as well, you isolate any liabilities, taxes in particular, from the other country. So if you have company that's headquartered in Colombia operating via employees somewhere else, you probably want to have two legal entities. Sometimes, if you've got one employee somewhere, then you have to do kind of a cost-benefit analysis. Do I really want to set up a company? But these are the kind of things that, that we all work as advisors to prevent you from having problems down the road when the rubber really hits the road and you're raising a big round or getting acquired.
The related part of that answer, Ali, is you want to also have a clear picture for your intellectual property. Assuming that your IP is a key part of your business and a key asset, value, that you have an understanding with your advisors, your tax and legal advisors, where that intellectual property should sit. Which of those entities in the corporate structure owns your intellectual property, so that you don't, in a perfect world, have it spread out in various countries, various parties, and you don't have clarity as to who owns what or who's licensing what, which we have seen be a real mess when those investors and buyers and their lawyers are crawling over your entire company.
Yeah. Well, these are wonderful advice, and I thank you all for answering these questions. And like I said, please send them a little bit more personalized, and we'll be happy to reach back and get to know each other a little bit better. And thank you so much, Andy, Dan, Anna, Felipe, and Fabio for your time today and explaining all of this wonderful information. And I hope the audience can take this back and relate, and we'll be here to help. So I think we reached the end of the webinar, and I thank you all for being here. And from Moss Adams, Gunderson Demmer, J Del Rio, Alameda, Ruta N Medellin, and Angel Ventures, we really do appreciate your time and effort in being here today. So if you have any further questions, just contact us, and thank you very, very much for your time. Hopefully everyone has a great day today and a nice weekend too.
Thank you very much.